want to stop, pause, and think about it or not, there are tax implications associated with that. So what I want you to do is start being more thoughtful about your tax situation. Oftentimes, I'll get clients coming to me who have made transactions that were not tax smart decisions. So where they thought they were going to make money, they ended up not making as much as they thought they were going to make. So I want to get you guys in the habit of making tax smart decisions. Does that make sense? And then we're going to talk about wholesale properties. I have a special guest with us this evening that I'm going to be interviewing. We're going to talk about what does it mean to acquire wholesale properties? How does that work? What do we do to make that happen? And that is really interesting to me, and hopefully it's interesting to you guys. So let's go ahead and get started. So my very first question out the gate is, what's your tax strategy? How many of you in here have a tax strategy? All right, so nobody in here has a tax strategy? That's a little scary for me. All right, so does anybody know what that means when I say, what's your tax strategy? No? All right, so let me explain what I mean by that. When I say, what's your tax strategy, how many of you know that we had a major tax law change? Right? Does everybody know we had a major tax law change? So last year, December 2017, we got a new tax law signed into law that went into effect 1/1 of 2018, and some of those provisions went into effect December 2017. So when I ask you what your tax strategy is, I'm asking you, what are you doing to make certain that you don't overpay Uncle Sam? What are you doing to make certain of that? Many times we think that there's nothing we can do. We think of taxes come January through April. Do you guys think that's pretty common, right? We think of our taxes come January through April. But I'm going to say to you, your taxes need to be looked at all year long. And you need to get really strategic about it. So let me use this scenario. Right now, I have my 16-year-old son who is studying for the SAT. He will be sitting for the SAT exam in December. So he would like to study for the exam the night before, right? And then just take the test on that Saturday. My philosophy is, we know this SAT is coming. You guys know your tax bill is coming in April, right? We got to file those tax returns by April 15th or go on extension. We know it's coming. When do we know it's coming? We knew it was coming from January 1st, 2018 through December 31st, 2018, right? We have 12 months to plan for it. But most of us don't plan for it. We just go about our day, we collect our income, and whatever write-offs we have come the end of the year, come time to file our tax return, we just roll with those write-offs. What I am going to say to you, those individuals that make money, keep money, own property, are wealthy, that are living in their retirement and not having to compromise their lifestyle, those individuals that are not overpaying the government, are not paying the government, period, is because they have employed tax strategy all year. They have not waited just until January or February or March or April to meet with their tax person. They've met with their tax person all year, and they've structured a plan to reduce their tax bill. Are you guys with me now? So when I say, what is your tax strategy? What are you doing to reduce your tax bill? That's really my question. And you may not have a strategy right now, but I hope by the time you leave this evening that you will at least think about, what's my strategy? What am I going to do? And if nothing more, we probably need to have a conversation so that we can reduce your tax bill. And you probably may be thinking, Carla, what is that going to look like? What do you mean by reduce our tax bill? I am going to take you guys through an example of someone that I recently did strategy with that took them from a tax liability down to zero. And I'm not going to say I will take you down to zero. I'm certainly not going to say that. But what I will say to you is that chances are I will be able to reduce your tax bill. That's what I will say to you. So this evening, I am going to walk you through some strategies that you can employ on the sale of your real estate, if you're dealing with real estate, I'm going to give you 4 strategies that you can utilize to reduce your tax bill. Is that okay with you guys? All right, so let's move forward with that. So strategy number 1 is going to be installment sale. How many of you guys have sold real estate? All right, how many of you heard of installment sale? Okay, a couple of you? All right, an installment sale is where when you sell a piece of real estate, you're going to take your payments, your money in installments. You're not going to take it all up front in the year that you sell it. So what does that look like? So let's say, for example, I, Carla, want to sell a piece of property to you, for example, and I may want to carry back a note for you. I may be interested in, oh my gosh, I need to sell this piece of property, but I know I'm going to get slammed with taxes if I report all the income in the year that I sell it. So if I get the buyer to negotiate with me an installment sale, I can defer my income, my gain, and report it over time. Does that make sense? So I have a client right now who is selling some property, and when I ran the numbers for him, if he reported all of his gain this year, he would have paid a substantial amount of tax. So we structured a 3-year installment sale for him so that he can report that gain over a 3-year time period, which drops him in a lower tax bracket overall. He's going to save about $125,000 in taxes. That's quite a bit of money. So when you are thinking about selling property, just remember that you could potentially do an installment sale when you're getting ready to sell property so you can defer the gain. Does that make sense to you guys? And it needs to be the right scenario, the right strategy, right, the right buyer. All the ducks need to line up, but that's something out there that you can look towards. As long as there's one payment after the close of escrow, it can be set up as an installment agreement. Make sense to you guys? All right, let me tell you another time when an installment agreement may be useful for you. I had a client, and we're going to talk about 1031s this evening. I had a client who was doing a 1031 exchange. It was a failed 1031 exchange. He was not able to find additional property. So we decided to structure it at the last minute as an installment sale because he did not take possession of his cash in the year he sold, right? Because it was in the middle of the transaction. By us structuring it as an installment sale, he was able to reduce his tax liability and not get hit with such a big tax impact. So it's useful to know that you can do an installment sale. Just keep that in your back pocket as a potential strategy in the event that you're selling real estate. Make sense? All right. So let's go now to another strategy I want to talk about, the live and flip. Has anybody heard about this? The live and flip? All right. One person's heard about it. Very good. What have you heard about it? I'm going to pick on you.
You buy as a flip, you live in it for 12 months and a day.
Okay. What happens if you're living in 12 months and a day?
Not short-term capital gains.
Long-term capital gains. I like that. I like that. So the live and flip is not exactly that, but you're on point in terms of what you're saying. So when we are purchasing a piece of property and we are rehabbing it and we're selling it, that's called a flip, right? Are you guys familiar with that term? That means we're flipping property. And when you flip property, typically just depends on how often you do it and what your strategy is. Typically when you flip property, that property is going to get hit with ordinary income tax. If you're a flipper, if you do it every now and then, it will get hit with capital gains tax every now and then. All right, so if you purchase a piece of property, you rehab it, then you move into that property or show that property as your primary residence for 2 out of the last 5 years, and you turn around and sell it, what happens?
Zero. No capital gains.
No capital gains if you turn around and sell it, okay? So technically, We can flip property every 2 years and do that if we wanted to, right? We technically could. Now, to your point, you said if I live in the property for a year and a day, and you wouldn't even have to live in it for a year and a day, if you technically held it for a year and a day, you go automatically to capital gains, long-term capital gains. So I want to make sure I clarify for you. When you sell property, if you sell it as a capital asset, meaning I'm routinely just every now and then selling a piece of real estate, that's going to get hit with capital gains. Now, whether short-term capital gains or long-term capital gains is going to depend on how long you held the property, how long you own the property. If you own the property for a year and a day, it's going to go long-term capital gains. Short of a year, it's going to go short-term capital gains. That means an income tax rate is going to be different, right? Now, notice I said if you periodically sell, if this is what you do, you're a flipper, you're selling more than 2 properties a year, it's going to go with ordinary income tax rates, not capital gains rates. I just want to make sure we're clear on that. All right, did you have a question?
Yeah, first, how much is the difference between those 2 rates?
Oh, it could be, the difference between those 2 rates can be upwards of 10 to 12%, depending on your tax bracket.
Which is worse?
Worse is short term. Short-term capital gains is worse. Long-term capital gains is better. You can get down to 0% on long-term capital gains, depending on where you are. Long-term capital gains is always going to be better than short-term capital gains.
So is short-term the same as ordinary?
Pretty much. Yep. Short-term is the same as ordinary. That's right. Mm-hmm. Look at you learning something.
So you're saying that you can only sell 1 property a year?
About 2. You can sell about 2 properties a year.
Yeah.
Mm-hmm. And the reason why I say you can sell about 2 properties a year is because I know from the time that I've been doing this, and I've only been doing taxes, what did I say, 20 years? Only in 20 years, that when IRS is audited, I've never seen them question a flipper who's only flipped about 2 properties a year. If you start to go into more than 2 properties a year, then you're considered a flipper.
Yeah.
So that's kind of the little litmus test there. Now, is that written anywhere in the code? No, but that's based on practical knowledge of what I've seen in dealing with IRS. Make sense?
How about living in it for 12 months and 1 day? You can't live in 2 properties for 12 months and 1 day.
If you live in it 12 months and 1 day, I want to be real clear. If you live in it for 12 months and 1 day, you're only getting yourself to long-term capital gains. That's the only benefit you're getting there. And you don't even have to live in it. You have to hold it. You have to own it for 12 months and a day, okay? The living part is 2 years, so you can sell it as a primary.
In 2000, I did a lot in 2000 for 1031s. You had to live, you have to own a property for 5 years and live in it for 2 years, but then they changed it in 2003 or 4 to 3 years. You had to live in it for 3 years, correct?
Mm-hmm. Still 2 years.
It's back to 2 years
Yes,
now.
it's still 2 years.
Okay.
Yeah. All right, so you guys with me on that? All right. All right, so let's go to our next strategy. So you guys completely understand the live and flip, right? You buy the property, you rehab it, you live in it for 2 years, you sell it. You're selling it based on a primary residence, excluding $250,000 a gain as a single person, $500,000 as a married couple. All right? Just want to let you know that piece. So when is this strategy, you should employ this strategy? I would do this if I were looking for maybe a primary residence, if I didn't own property, if I wanted to pick up property for my kids, I don't know. This strategy to me is very useful depending on the right circumstances. Right circumstances. All right, 1031 exchange. Are you guys all familiar with a 1031? Some of you? Okay, everybody's not raising their hands, so let's talk about this. The 1031 exchange is very useful. This is where you sell a piece of real estate and you exchange it for another piece of property. 1031 comes from the tax code 1031. When you exchange it, you're exchanging this property deferred, tax deferred. That means if I sell my piece of property, let's say I have a duplex, an apartment, I sell it and I buy a property for equal or greater value, I am going to sell it and exchange it to another property without paying the tax at that time. It's deferred until you sell that property. You can keep doing this over and over again. Are you guys with me on that? Yeah. All right. So you can 1031 and defer tax. But let me bring something to your attention. This is what's happening. Do you know who monitors 1031 exchanges? Franchise Tax Board. Why does the Franchise Tax Board monitor 1031 exchanges? Because of what? They want the tax, but what else? What happened when they came out with that 593 form? When you sell property in the state of California, the Franchise Tax Board wants that 3.5%. All right? That came out a few years ago. With the Franchise Tax Board said, if you sell property, we want you to fill out this 593 form, calculate your gain, and we want 3.5% to be paid to the Franchise Tax Board. Well, once that happened, the Franchise Tax Board started realizing people were just filling out the form and they were getting zero. So then they started auditing 1031 transactions. That is what's happening right now. Franchise Tax Board is auditing 1031 transactions. So what's the real important part of that? What's real important about that is making certain that you are utilizing the right accommodators. Because what I am seeing, I'm doing a lot of representation in this area right now, helping taxpayers with these audits. What I am seeing is these 1031 exchanges are not equal. They're not equal. They're being passed off as though they're equal, but they're not equal 1031 exchanges. So you have to be really careful. My advice is going to be that if you're going to do a 1031 exchange, get your accountant involved. Make sure they run the numbers. Make sure they make certain that the transaction is equal. Because when you're doing a 1031, if you have a mortgage on the property, if you're acquiring another mortgage, if you're putting in cash, taking out cash, all of the costs may not be deductible. It's an entire calculation. Right now I have 2 cases where the 1031 exchange was not an equal exchange and the taxpayers are owing back like $70,000, $50,000. And they don't have that cash. Yes?
What do you mean equal?
What I mean by equal is that when you do a 1031 exchange, you have to make certain, number one, that you're purchasing an uplet, that you're purchasing a higher value property. That's the first thing. But you also have to make certain that if you have mortgages, that you equalize the mortgages. You have to make certain that there's no cash being received out of the transaction. And you may receive cash, but not necessarily receive cash in your pocket, because maybe you had a mortgage on the first property that the new buyer is being paid off, right? But you're not taking a mortgage on the other property. There's a whole calculation within the calculation that has to be done to make sure the transaction equals out.
Can you do that from state to state? Can you sell property in one state and buy it in another state using the 1031?
Absolutely. You can 1031 on any property inside the United States. You just cannot 1031 outside of the United States. Yep. So you can go from California to Nevada, North Carolina, vice versa. But if you go out of state or out the country, it's not going to be considered a 1031. Yes.
Is it true in that scenario that California will want their money, but the federal won't take it?
No. If it's a like-kind exchange and you fill out the 593 form properly, California should not get any money either, if it's filled out correctly. Yes?
If you have a second home and you want to do a 1031 exchange on it, how long do you have to rent it out for that previous year?
A year. Just a year. Yep. A year. Then you can do a 1031. Any other questions on that? All right. So we talked about the 1031 exchange. We talked about the live and flip. And so now I want to talk to you guys about the cost segregation study. Do you guys have this form at your desk, at your seats? How many of you are familiar with a cost segregation study? All right, a couple of people. Before I go into a cost segregation study, I'm going to poll the room. How many of you own real estate? investment property, rental property. Hold your hands up high. Be proud of that. What's happening in here? They're not going to get you. All right. So you guys, I'm not the government people. All right. So you guys own real estate. How many of you guys manage your own real estate? Okay, very good. How many of you have acquired real estate in the last 10 years? All right, very good. How many of you have done cost segregation studies on those properties? Okay, one person. All right, that's fine. So let me tell you something. A cost segregation study is like, I don't even know how to explain it. I don't want to date myself, so I'm not even going to use this analogy. I'm going to use, how many people remember e-tickets in Disneyland? Right? I don't know anything about this. We're not even going to talk about e-tickets in Disneyland. We're not having that conversation. All right, a cost segregation study is like Willy Wonka and the Chocolate Factory. It is like a goldenrod ticket. When you own real estate, you are depreciating that investment property over time. Are you guys familiar with that? Depreciating it over time, right? And we're depreciating it over typically 27 and a half years or 39 years, right? Are you guys with me on that? So we have a piece of property that we purchased for $100,000, and let's say it's all building. We purchased it for $100,000, and we're depreciating that property over 27 and a half years. How much of a write-off are we getting every year?
Less than 4,000.
How much?
Less than 4,000.
We're getting less than 4,000 every single year, right? So we're getting a deduction for less than that. Now, let's fast forward. Let's say you do a cost segregation study. If you do a cost segregation study, you're probably going to be able to take about, on that $100,000 property, probably about 40 grand in the first year. Literally. I know, you're looking at me like, what? I saw that throwback. Literally, you'll be able to take a big write-off in the first year, the second year, and the third year. This year, IRS has come up with what's called bonus depreciation. So if you do a cost segregation study, they take your property, your building, worth 100 grand, then they break it down and say, this portion right here, we're going to be able to fast forward that write-off. And let's say that portion is 40,000. You're going to be able to take that whole 40,000 in 2018 as a tax write-off. Are you guys with me? What do you think that would do for your tax bill?
Drop it down.
Drop it down, right? As they say, that would drop it like it's hot. Really. It would like drop it like that. So I am saying to you, if you own real estate and you purchased it within the last 10 years and you are an investor and you need to reduce your tax bill, or if you want to give Uncle Sam a Christmas present, totally up to you, I would look at doing a cost segregation study. And you need to do that immediately. So what I did for you is I gave you a case study of a cost segregation study. And this particular client owed IRS $58,000. After we did the cost segregation study, the client only owed IRS $38,000. That was a $20,000 savings. $20,000. That's a lot of money to not give Uncle Sam. Are you guys following me? I don't care if it's $5,000, $2,500. I'd rather that money be in my pocket than be in Uncle Sam's pocket, right? Because if we're investors, what do we do with our money? We invest it, right? I don't know anybody that's got a dividend on investing in the government. I'm just saying, I don't know. Right? So I am going to say to you that we need to have that cost segregation conversation. If you own real estate that you purchased within the last 10 years and you have not done a cost segregation study, we absolutely need to have that conversation, because that is going to be your e-ticket for those of you who are old enough to know what that is. That is going to be your e-ticket to get on that ride at Disneyland, right? I'm telling you, you have to look at doing a cost segregation study. Are you guys following me? Yes.
So if it's more than 10 years, the acquisition date is more than 10 years ago, it doesn't make sense.
It might. So as a rule of thumb, if the acquisition date is 10 years or less, absolutely it makes sense. If it's more than 10 years, we need to look at it. That's just the rule of thumb. Right now, we have some cost segregation studies going on some property that's around 15 years, but it made sense for that taxpayer. This year, we can do what's called catch-up depreciation. So in the new tax law, the person that championed that law owns a lot of real estate, right? The president, he owns a lot of real estate. We all know it. Don't shoot the messenger, I'm just saying. He owns a lot of real estate. So in that law is a lot of benefits for real estate owners. So if you're sitting on real estate, there's a lot of benefits out there for you. That's really the takeaway. Make sense?
And that law again was what?
That's what?
The law was, again, the update to the law is, what do you call it?
The update to the law, it was just the tax law that just passed. So I'm saying there's a lot of benefits, and I call it catch-up depreciation. Yep, catch-up depreciation is the term. All right. Are you guys following me so far? Yes.
So basically cost segregation, as I understand, what you're doing is instead of taking depreciation over 27 years, part of it you accelerate it and take it in 40 years.
That's correct.
Correct?
That's correct.
Some of the items are depreciated over 3 years, some are after 5 years, some are after 7 years.
That's correct.
So what happens after those depreciations expire? So the depreciation you are taking after all these periods, wouldn't your, like the amount you depreciate would be reduced?
Yes. So what you're asking me is what happens when the depreciation runs out, right?
Yeah.
Yeah. So we come up with another strategy. So the key is always to fast forward deductions, to take every tax year and take that tax down as low as possible, and let every year work on its own. Because right now, we have this opportunity until 2025, right? So basically 7 more years. And 2025, we don't know what's new gonna come, but this is on the table right now. So certainly you're gonna run out of depreciation faster, but it's all about the time value of money and making sure we're getting our tax deductions fast forward as much as possible. By the time we get to 3 or 4 more years, they'll come up with something else, and they do every single time.
And the second question is, there's a cost involved in doing the segregation study, right?
Does it what?
There's a cost involved in doing the.
There's a cost involved in doing a cost segregation study, absolutely. But I can tell you, your return on your investment is probably going to be 300 or 400 times the cost. Yep, definitely worth it. All right, are you guys good on that? So everybody now knows what a cost segregation study is? Let me see a show of hands who knows what a cost segregation study is. Just a few? All right. Those who don't know, I want you to stay after class. I'm going to talk to you. We're going to make sure you know. All right. So now we're going to talk about how to acquire wholesale real estate and really get into the nitty-gritty of this. So I am pleased to tell you that I have with me a lady that I've met, that I've done some business with. Her name is Linda Delgado. And Linda is a licensed real estate agent. She has been in this business since 2004 doing what she does. She deals with buyers, sellers, and she deals with flippers. She deals with wholesale property. So I asked Linda if she would join us tonight, and I am going to interview Linda, ask her some questions so you guys can get a real feel and flavor for what it's like to acquire wholesale property. What does that need to look like? What do you do? How do you flip it? Linda also brought with her construction gentleman who she works with on flips. So if you guys could welcome Linda, and we're going to sit here and we're going to
Andrew Williams. Investors.
You want to pull up another chair?
He will be chiming in on things.
Well, you know what? You can sit here. I can stand, actually. Yeah, I'm good. I can stand. I need to stand. I sit all day.
You sure?
I'm positive. Trust me. All right, put my glasses on so I can read these questions. It's pretty small. All right, so Linda, welcome. We appreciate you being here. So the first thing I want to know, Linda, why did you get into real estate? That's my first question.
Well, I love working with the public. I've been in sales prior to being a realtor. for years, and the enjoyment that warms my heart when I take a family to view a home, and the children get so excited they're going to get their own room. It's a beautiful feeling. And then it's a key exchange, when I finally give them their keys and the smile on their face.
So it's a passion.
Yes.
Very good. I want you to tell our audience, what's the definition of wholesale property? Because we hear about wholesale property, REO property, all of these different terms. So what's the definition of wholesale property?
Wholesale property, and then you can add, Andrew, after I'm finished, but it's a property that a seller has agreed to sell, and the owner. It could be distressed, it could be they just let the property go and they want nothing to do with it, and so they contact a wholesaler to market that property.
So a wholesale property then is a piece of property that is being really sold at a discount because the seller really wants to get rid of it.
Yes, thank you.
Got it. And so then how is that different from an REO property?
It's different because the price is drastically reduced for a wholesale property.
Got it.
Chime in.
And also on top of that, with REOs, once that market goes into MLS, everybody gets a piece of the pie. You know, everybody wants to. You got 10 different investors trying to, buy that same property. With wholesale properties, it's kind of exclusive, so you can kind of, get more.
REOs become a bidding war. So actually, the price is that they list it. It could go up 10, 20,000 because of the fact there's so many people that are interested in that property. So really, you're not paying a good price for that home.
Got it. So REO properties are bank-owned that are listed on the MLS, where wholesale properties are kind of pocket listings, exclusive listings that you can get access to prior to it going on the MLS.
Correct. With a discount.
With a discount. I like that. How many of you guys like a discount? No. Ooh, got your attention in, right? All right then. All right. So, and then you said a person would want to acquire wholesale property versus a foreclosure because there's a bidding war typically on foreclosures.
Correct.
Got it.
Correct.
When a buyer wants to acquire wholesale property, what are the steps they should take? Like, let's say I want to get a wholesale property. What should I do in order to make that happen?
First of all, let me explain. There's investors, there are also couples that love to flip. You get a contact that has access to many wholesalers. Then you are registered with your email address, and I send out properties daily to people who are interested. One may not be your cup of tea, it might be another property. It all depends on your cities of preference, your price range, what's good for your pocketbook. So then the process is that you have to be ready with your funds. If you don't have liquid assets enough to cover the price of that property, you need to get a hard money loan, because the wholesaler only holds it maybe at the most 3 to 5 days, so you have to move fast.
So if I'm hearing you correctly, Linda, is when you want to acquire wholesale property, this is not financed. You're not like going to a lender, you're not trying to get a loan. You got to be ready to move with your money.
If you have the liquid asset. If not, then you do use a property that you own to acquire, and it's like all cash. It's a hard money loan. You'll be charged a higher interest rate, 10 to 15% at times, depending on what you have. Maybe you have 20,000, maybe you have 30,000 in the bank to put down. That's how a hard money lender will specify the type of loan you're going to get, but it will be all cash.
Got it. So it will be all cash. So let's say now I'm on this list, I get this property, and I get this listing of properties, and I see something that I like, and I'm ready to move forward with it. How much time do I have to move forward with the property? Do I get to inspect the property? What does that look like?
Yes, you call me, I set up an appointment to view the property gets opened up, though we take our contractor with us as well. This way he can scope out exactly what needs to be rehabbed. What's gonna cost out of your pocket. You may say it's too much, you may say this is a great buy, let's go.
Got it.
And just to add to that, as far as, getting in there and locking the property up with the wholesaler, you typically wanna get in there within like 1 to 2 days and get it locked up.
Okay, got it. So I'm in the property and we're together and now I'm with my contractor and my contractor tells me what needs to happen. And he says, okay, Carla, it's $40,000 to rehab this property. That $40,000 has to come out of my pocket. That's not part of the hard money loan, is that correct?
It's part of the hard money loan.
No,
Okay,
go.
Okay, you can get it worked into the hard money loan.
Okay.
Little bit of background on me, I've been doing flips since 2000. I average about 6 flips a year, and that's all I do. I eat, sleep, and breathe real estate. I love doing real estate. So I have a good relationship with 3 of my hard money lenders, and they open the doors for me. They're like, hey, whatever you need, we'll do it. 100% financing, meaning they'll finance the purchase of the property, and they'll finance the rehab
Got it.
for you at
So-
100%.
Wow, so we can get the property financed and we can get the rehab financed.
Correct.
So do we have to come in with any funds?
Closing costs, a little bit of closing costs and points. They might charge 1 or 2 points on top of the loan.
And then do we need to put some type of deposit up? So like, is there 10 or 15,000 I need to put up as an initial deposit?
Earnest money might be around 4 or 5,000, could be even $10,000.
Okay, so I just want to recap this and be real clear. Got you. I want to recap this and be real clear. So the hard money lender is going to give me the money to purchase the property.
Correct.
The hard money lender is going to give me the money to rehab.
Correct.
And the only thing I may need to come out of my pocket is anywhere between $4,000 to $10,000.
Correct.
Yes.
If the deal is really good and they like it.
Okay,
Yes.
so the hard money lender kind of looks at the deal because he has to like invest in the deal,
Correct.
basically to decide how much he's really gonna lend on that property.
But once I take it to the hard money lender, and because they know how I work, it's pretty much a done deal.
And
Okay.
they will pull excuse me for interrupting, they will pull comps in the area to see if that property is worth the value, what it's being sold for.
Because they lend 75 to 80% of the future value, meaning once the property is fixed up, they lend on that.
Wow, got it. Okay, I'm gonna take your question.
Yes, during this discussion, you haven't mentioned the realtor. So
We're gonna get there.
How do you lock up the property?
As a wholesaler,
Yeah, so what she's asking is, so let's say, for example, if you get on the list with, and correct me if I'm wrong, but I just wanna make sure I got this. So let's say you get on the list with a wholesaler, right? Typically, if you get on the list with a wholesaler, like for example, if Linda's, if you're gonna work with Linda or whomever you choose to work with, they're probably gonna be representing you as the lender, as the realtor, is that correct?
Correct.
They would be representing you, and then they would be doing what they call a quick offer or something, right? What is that called?
It is called a quick offer because of the fact that the wholesaler will send you, once it's solidified, he will send you the quick offer, not before. It's until after you agree. Then also too, if there's they might ask for 30,000 EMD. They might ask for 40,000 because of the deal.
Right.
So that money, you have to be prepared with that money, correct?
In some cases.
In some cases.
Some wholesalers might be like, hey, just put $3,000, $4,000 down and it's yours.
It all depends. Every wholesaler is different the way they send us the properties. And when the,
Does it go into escrow? or-
it's a
Absolutely.
quick
Absolutely. It's the
escrow.
same as a real estate transaction, same thing.
But you say a quick escrow, so typically escrow is about 30 days. What's a quick escrow?
5 to 10.
The hard money or private loans, they normally, their turnaround time is normally 5 to 10 days. I've personally done a deal and locked it up and got it done from beginning to end in 5 days.
Wow.
So can you talk a little bit about dealing with hard money lenders?
We're gonna get there. I'm gonna go through my interview questions and I'll follow up, okay? But I will cover that because that's in my questions. Very good. So now that we now have this property and we decided we want this property, an offer gets placed, right? And then once it goes through escrow, it's gonna close escrow
Correct.
within 5 to 10 days, or however long that period
Correct.
takes.
Correct.
Once it closes escrow, what's the next thing that needs to be happening?
Contractor, that's where I come in. We go in, we look at the property, and then we just kind of figure out what's our first step. We're gonna pull permits with the city if the property's in really bad condition.
Can you speak up a little louder?
Oh, I'm sorry. First thing we're gonna go in the property, and then we're gonna assess the property, and then we're gonna pull permits if we need to, and then we'll just start going from there. Start working.
Got it. So basically what he's saying is that once you guys have gone in the property and you have come in with your buyers, right? Because the buyers can bring in you or any contractor that they
Correct.
choose to,
Correct.
Yes.
any contractor they choose to utilize. That contractor should have some scope of what the work needs to be done on that particular property,
Correct.
right?
Correct.
So then, once that scope of work is kind of put into place and that escrow closes, I would imagine that you want that contractor in and moving as quickly as
Correct.
possible
Correct.
to get that property rehabbed.
Because while you're purchasing the property, you have an inspection period, maybe 2-3 days to inspect the period. We're gonna go with you so we can inspect it. So we're gonna know exactly what's going on, and then by the time escrow closes, then we go back and then we know what we gotta do.
Got it. So I want to back up a little bit. When you're going to look at these properties and we need to decide, I would imagine, if I want to pick up a wholesale property, I want to think strategically. So we're buying these properties to fix up and flip.
Correct.
Let's just say, worst case scenario, I can't flip it and I need to hold this property and rent. Worst case scenario.
Okay.
For me, I would want to at least know that I'm buying a property in a particular area. So I would want to kind of scope out the area.
Okay.
If I had to hold this property as a rental,
Okay.
that's an area I would want to rent in.
Correct.
At least that's something I would want to consider.
Right.
And maybe you guys would want to consider that too, right? If you had to turn it to a rental, as that's your escape hatch, would you want to hold that property in that particular area? Something to consider. I would also think, correct me if I'm wrong, that when I go out to look at this property, I want to look at other things too. I don't want to just look at the rehab work, because the point of this drill is I want to flip it quickly, right? Flip it quickly.
Bring it in and out.
In and out. So then I would want to look at the surrounding area,
Correct.
right?
Correct.
If the neighbors are next door are thumping music or doing, I don't want to be next door to a marijuana thing or any kind of crazy stuff going on, because that means your property's not going to sell fast.
You can do a drive-by at night,
Yeah.
on the weekend.
Do a drive-by at night on the weekend, things like that. So some of the same parameters that we're looking for, if it was an investment property that we're going to hold, are the same parameters we need to be looking at if we're going to flip this property.
You want someone to buy that property?
Correct.
Yes.
Right.
And you want to look at if there's any houses for sale in that neighborhood. There's not a lot of houses for sale in that neighborhood.
There's something wrong.
All right, so there's not a lot of houses for sale, that's good too.
That's good. That's good.
All right, good, because that means when I put mine up, it'll go.
Correct.
Gotcha. Okay, I'm gonna hold your question. I'm gonna go through my questions first. So I'm gonna back up to the hard money lender. What is a hard money lender? Like we hear, when I think of hard money lenders, I think of those TV shows of those guys, they lend you money, they come hit your knees with a bat type of thing.
No.
What's a hard money lender? I really want to know what exactly is that, and are they coming to get me out of my house?
No. A hard money lender or private lender, they pretty much, let me back up a little bit. When you purchase a distressed property, it's not going to qualify for regular conventional financing.
Okay.
So a hard money lender, they bypass that, and they pretty much, they'll buy the property, finance the property, sight unseen pretty much, in the condition it is, charging you a higher interest.
So hard money lenders are basically investors in that they invest their money and get interest rates back on it. So they're making their money off of the interest.
Exactly.
I just want to make sure they're not coming to get me.
No.
All right. I just want to be real clear.
I might add you, as far as me and what I've been doing for so long, I always pay my hard money lender back. I will go hungry. No, really, seriously.
Is that because they're going to come get you?
No, not because I'm always going to want more business in the future. And
Yeah.
now they call me in a regular, hey, what do you have for me?
Got it.
That's very rare.
So it's important then to establish a relationship with a hard money lender, because then he believes in you, will start to give you more money, invest in you, and so
That's
forth.
how you get the 100% financing.
So how do we get a hard money lender? It sounds like you know everything.
I've been doing this for a long time, because most lenders, they want 20% down or 30% down.
All right.
I might make or break a deal.
So then how do we get a hard money lender? So basically then, if we are getting properties from you, Linda, and I have to tell you guys, Linda sends me properties, and sometimes, like, I'm a tax accountant, right? But sometimes I'm on my computer looking at those properties going, okay, Carla, focus on the accounting you're doing. She sent me a property the other day, kid you not, it like showed the value after rehab was close to about 200,000 in equity sitting in that property.
Yes.
On Arlington?
It may have been, I know it was in LA.
There was one more in Los Angeles.
okay,
that
yeah.
And I was like, whoa, but I can't get caught up with another thing. Okay, I gotta stay laser focused. So I'm just telling you that I'm getting it, and so when you get this information, you're gonna get a listing that shows you the address of the property, I believe is on the listing, how much the property is gonna cost, what the estimated rehab is, and we say estimated because you may decide to go on this property and do something different or do something less. The estimated rehab, and then it's going to show the after rehab fair market value of the property. And correct me if I'm wrong, Linda, I think that's based on comps, right?
They sometimes even send market analysis, which are comparables of what has been sold in the past 6 months, 3 months. So you can base that home on what you're gonna regain once you have it to resell.
Got it.
And it's usually what I've been sending you, there's so many properties out there right now, you can make some good money.
So when you say make good money, so if I were gonna do a wholesale deal,
Mm-hmm.
would I do a wholesale deal to make 10 grand? Like, is there like a benchmark
No,
of
ma'am.
how much equity should be in that property for me to wanna do that?
It all depends on your pocketbook. Believe me, what you're comfortable with in, recouping once you have sold that property.
Mhm.
But there are some that you can make 50,000 up to 100,000.
Wow.
Because you gotta factor in the whole time once you purchase a property. You're gonna hold the property for at least 3 months, so you gotta factor that in too. And a lot of the, my hard money lender, they build the 3-month payments in the loan, so you don't have to worry
Which is
about
excellent.
nothing but fixing the property up for 3 months and
Mhm.
selling it.
Oh, wow, so you're not even having to pay the hard money lender in that 3-month time.
It's built into the loan.
And then you get me to market that property a couple of weeks before, coming soon. I start marketing that property.
Correct.
Then I start doing open houses so that can sell.
Got it. So, all right, so it sounds like, I don't know about you guys, sounds like this thing is sounding good, right? All right, but every good has a flip side. Let's flip it. What is the worst thing that has happened to you during this wholesale deal?
Me and Linda recently did a flip property together about 4 months ago. I purchased it, I think I paid $180 for the property. Put all new, brand new copper piping in the bottom of the property. Everything was cool, did all the plumbing work, everything. The next day I went to the property, to do some more work on it. All the copper piping was gone.
Somebody stole it. Oh, interesting.
All the copper piping was gone.
Wow.
Right.
So now that brings me to another question. So while you're in this deal, is it being insured? What is that looking like? Because I don't know if I can pay for copper piping
No,
twice.
well, it wasn't, they didn't honor the insurance. But I do my calculations. I based it on stuff happening, worst case scenario. So I factored that already, something crazy happening.
Got
so I really didn't lose in that
Got it.
pretty much.
So basically, when you're doing this, you need to make sure you factor in contingencies. So basically, when we own investment property anyway, right? If you guys are holding investment property, you're factoring in vacancies, that if the tenant doesn't pay their rent, you're factoring that in. So in this particular case, if you say the time to flip is 30, 60 to try to get out in 90 days, I would imagine I would want to factor maybe 120 days, a little bit longer, so that I'm prepared for worst case scenario. That makes sense? Okay. So then once the contractor goes in there and you do construction work, this is the type of work that you do. Okay, so once you go in there, you got it, everything all done, does the city have to come out and give us an occupancy permit or anything like that?
Some cities are different. I do a lot of work in Highland, California. So yeah, they do give you an occupancy certificate. So they come by and inspect the property and make sure.
depending on what had to get done. So if there was a permit, they're gonna sign off on that,
Correct.
that thing that has to get done.
It
Got
depends
it.
on the project and what how bad it is.
Got it, okay. So then we're listing it for sale,
Right.
and then that's where you need a realtor to sell it.
I go to Linda.
Linda sells the properties, and so
Correct.
Linda, when you're listing the properties for sale, like what's your strategy to get that property sold? Cause I'm at 89 days and I'm stressing, this is my first deal, you know, I'm panicking. What am I looking at?
I would put my sign up and put a writer stating coming soon, contact agent. This way I've already got, and I'm working it with people. This is the way the property is gonna look, this is what's happening, this is more or less the price, or not unless you've decided the price until then you tell me. But this way I can have a price range of what it will be. I start marketing this, whether on Zillow, on my MLS.
Got it.
and- Exactly. I
Got
mean,
it.
my MLS feeds into Redfin, Hot Pets, every.
So you're really
Every
kind of
site.
putting it out there to get the interest going. Now, when the construction people are in there working and you get the looky-loos, like the neighbors next
Yeah.
door, you know, the nosy people who want to come to your house and look. So I would think you want to kind of keep those people out, because when it's showing, you want it to show its best look when it's done. Would that be right, or how do you guys typically handle that?
I like the looky-loos.
Oh.
I love it because they might have a friend or a family member that might like that property.
Oh.
Hey, guess what? You got it. You qualify, you got it.
The looky-loos got
I
friends.
love
All
the
right. So you let the
looky-loos.
looky-loos come in.
Please come in.
All right. Are you guys okay if I open it up for audience questions?
No, absolutely.
All right. So does anybody have any questions? Okay, we'll start with you.
Yeah, you mentioned that you have to pay a high interest rate for the hard money.
Correct,
loan.
correct.
So the question was, Carla, you brought it up, that if you want to hold it or if you have to hold it,
Right.
how, firstly, how high is the interest rate on the hard money? And then secondly, if you want to go get a conventional loan from the bank or something,
Right.
how easy or difficult is it to get that?
Well, as far as your worst case scenario, in case you want to keep it, you can refinance the property. That's why we always make sure there's enough equity in there for worst case scenario. In case you can't sell that property for whatever reason, then you can refinance it, pull some cash out, go buy another property.
So I just want to recap. So it's really important, if you're going to do a wholesale deal, that you have a strategy. You got to have a strategy for worst case scenario. You got to have a strategy if you need to refinance and hold that property, if you need to put a tenant in it. Like, we're not just going out there doing a wholesale deal because it sounds good to make money.
Right.
We got to really think strategically
what you're
to
doing.
make certain that we don't get caught and can't handle the property. I think there was a question over here. Yes.
The hard money lender, can you just lay out what a deal might look like, getting money from a hard money lender? What does the deal look like? The loan.
Okay, I'll go to the deal me and Linda did. I purchased it for $180. Rehab cost was about $20,000, and fees on top of that, I paid another $5,000 in fees. They gave me the rehab. They financed the rehab. 3 months of payments in there was built into the loan. So I think my whole loan was about $220-ish around there, and then we sold it for $285.
They wait until it's sold to be repaid?
Yes, once escrow closes.
Once escrow closes, everything is paid back, and then that's how you make your profit.
But
So when
still,
you have let me just follow up to that question, because I think I know where you're going with that question. So when you're negotiating with your hard money lender, is there a contract between you and the hard money lender, some type of instrument between you and the hard money lender?
Yeah, well, you gotta send over your whole breakdown, your rehab bid, your purchase contract. You gotta send all that stuff in.
So is there a promissory note between me and the hard money lender, like some type of document I'm signing off on? Is he leaning the house?
Yeah.
Okay,
But
so
they're the lender. It's like
Okay,
a regular
lender,
loan. Right, it's
okay.
just a regular loan.
So if
They're
it's a
lender
regular
first.
lender, in that, is there not a time period I need to pay that lender back?
Some balloon payments are good. Like my hard money lender, my loans are good from anywhere from 1 year to about 3 years.
Got it, okay.
I don't need no more time than that.
So it's going to really be based on the relationship with the hard money lender, and how you negotiate that with the hard money lender. So it sounds like it's all negotiable.
All negotiable.
Got it.
Depends on if, it goes back to always paying them back and making your lender happy. It always go back to that.
Because they're going to come in with you with a bet. We're going to take 2 more questions. I want to be respectful of people's time. Right here.
Can you tell me something about gap lending? I know you've heard that before, right?
I've heard of gap lending. I'm not too familiar with the gap lending. I'm strictly a hard money private lender guy. That's my forte. He said.
She just asked you the question I was going to ask you.
Okay.
There's a paperwork involved in contracts and
Correct.
which one mentor of mine told me, he says, look, the contract is only as good as the person sitting on the other side of the table.
Yep.
So this is why you don't want to burn no bridges, you know.
You don't. And like me, I want to make sure they're happy. So I'm going to make sure my paperwork is in order. I'm going to make sure all my numbers are there. I'm going to put in like worst case scenario just in case. You know, hey, I might need to refinance this property. Hey, there's enough equity in there to do it. So everybody wins.
So you got to really run the numbers from the very beginning.
Correct.
One more question.
What's the specific criteria to get the 100% down financing in the private money lender?
Experience, paying back the hard money lender, the property itself. The property has a lot of equity in there. They like that.
So would we have to go through you for you to get the financing because you have a relationship
Correct.
with the lender?
Yeah, most lenders are not going to do that. Yeah, you can check on your own too. They want 10% down, 20% down. Yeah. Experience.
So it's a relationship based.
It's a relationship.
So the first time the hard money lender may give you $1, and then it just continues to build up from there. So it's about a
But
relationship.
if you flip 20, 30, 40 properties with them, of course they're going to give you the world.
So I think the recap is that wholesaling property and flipping probably is definitely something you can do to make money, put cash back in your pocket. Just like your taxes, you need to be strategic with it. It's all about the relationship. I wouldn't go out there and tie up 50 properties, start with one, a baby property, baby money a little bit, right? Then you graduate. And then once you do it for a while, just like when you got your first piece of investment property, you got one and you continue to grow. This is something you can continue to grow in. First of all, I want to thank you guys for coming and explaining this to them. That's very Yes. You can ask me a question.
Because there's other avenues. There's standard sales that I see daily when I'm looking for clients, and many times they'll say needs TLC, sold as is, so it could need about 50,000.
Right.
You can reduce the price, rehab the property, purchase it, and sell it as well.
Right.
Is that also included with the tax name?
Oh yeah.
Okay.
Oh, definitely.
Okay.
Oh yeah. There's a lot of things you can do. When it comes to real estate, so many different ways to make money. When it comes to real estate, right? You just really gotta do your homework. Work with people that know what they're doing, that have done it before. Like, I don't want to be the guinea pig, right? I don't want to go to anybody that I'm your guinea pig. So I'm just not going to do that. But I think it's important to build relationships with people. I brought them out this evening so you guys can hear about the wholesale market, what that needs to look like, how you can flip property, how you can make money before Christmas. Give yourself a present under the tree, right? Who knows what that looks like? But at the bottom line, what's the bottom line? No, wait, hold up. What's the bottom line?
Don't overpay taxes.
Don't overpay taxes. Make it, right? But if you make $100,000 and we give 60 to IRS, I don't know about that strategy. That's not a good strategy. So as usual, I welcome for you guys to fill out your consultation cards. We offer a 30-minute consultation. If you guys would like to meet with Linda and have a conversation with her, please put that on the card. We will get that information to her. Very, very important. Those of you who are not doing cost segregation studies, make certain you talk to us about that. Tik-Tok. When December 31st hits, I cannot help you lower your tax bill. The time is now to take action. I want to thank you guys for coming out. My name is Carla Dennis. It is always my pleasure to talk to anybody that wants to talk about tax. Thank you so much.
Thank you.